Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
If you've been listening to the podcast for a while, you've probably heard this term thrown around, cost segregation. It's a big, fancy sounding thing that a lot of us have heard of, and a lot of us don't really understand exactly what it is. Well, today we've got an expert, Erik Oliver, zooming in from just outside of Salt Lake City, Utah. And Erik knows a thing or two about cost segregation. That's what he helps investors do. So Erik, welcome to the show. Great to have you.
Yeah, glad to be here. Thanks for having me, Dave.
So you probably get sick and tired of this question, but I'm going to ask it anyhow. Explain it to me like I'm a dummy, because we won't be far off. What exactly is cost segregation? I mean, I think I got an idea, but I might be out to lunch.
No, that's a great question. And I'm going to use the analogy I've used with my kids, because my kids ask me that all the time. They're like, Dad, what in the hell is it that you do?
How old are your kids?
I've got an 18-year-old and a 15-year-old. So
okay, does a 15-year-old get it?
Yes, when I explain it this way. So I'm going to get it that way.
So let's pretend your 15's 12, and then maybe I'll get it.
So I'm going to hold off on the real estate piece for a minute and just kind of explain to you the idea. But the idea is, I use it in terms that my 15-year-old daughter would understand. So she likes Chick-fil-A. So when you go to Chick-fil-A and you get a Chick-fil-A sandwich, pay, I don't know, $7 for the sandwich or whatever. What we're doing is segregating that $7 of cost into different buckets per se. So we come up and say, okay, you spent $7 for the sandwich. Well, the chicken breast was, $3. The breading was 85 cents. The pickles were, 45 cents a piece. The bun was 85 cents. And we segregate the cost so that it totals the full $7, but we do that for buildings. So let's talk about buildings, because I think it makes more sense for probably you and your audience versus my 15-year-old.
I think so. Yeah.
So
I like Chick-fil-A and everything, but yeah, let's talk about buildings.
So I got to explain it to her in things that she understands. But for us, let's talk about buildings. So when you buy a building for investment purposes, the IRS allows you to depreciate that over a certain period of time. And that's a given time that the IRS has put out. So for residential units, it's 27 and a half years. For commercial units, it's 39 years. Well, that's great. So let's just make the math easy. I buy a $275,000 home. I divide that by 27 and a half. That's about $10,000 a year in depreciation that I get. And I should back up a little bit. Depreciation is basically a non-cash expense. So it's no different than any other business expense, but I don't actually have to put money out. The IRS says, hey, your building is deteriorating each year, so we're going to let you write a little bit of that off.
Yeah.
Again, residential units over 27 and a half, commercial units over 39. Well, the challenge with that is, as an investor, I may not own my single family rental property for 27 and a half years. I want my deductions now. I don't want to wait. And so the way we're able to do that is through an engineering-based study where we segregate the cost into those different buckets. So the IRS says, for example, that carpet doesn't last 27 and a half years. Carpet is a 5-year asset. Driveway is a 15-year asset. Your fence is a 15-year asset. Your appliances are a 5-year asset. So we go in and we take your $275,000 purchase price and we go in and say, okay, well, what kind of appliances are in this building? What's the value of those appliances compared to what we paid for the building? And so we provide basically a revised depreciation schedule. Instead of depreciating that building as one big thing or one Chick-fil-A sandwich, we're now breaking it into the individual parts. And the reason we do that is it allows us to front load or take the depreciation at a much faster rate. When we put a $1,000 valuation to your range, for example, or your refrigerator, we now get to depreciate that over 5 years versus 27 and a half years. And so that is cost segregation. Let me add one other piece, because there's a new piece of legislation that basically puts cost segregation on steroids. And I think sometimes people get it confused with cost segregation. So cost segregation, we were doing that. We've been doing that for the last 15, 20 years.
Yeah, that hasn't changed too much.
That hasn't changed, right.
Divvying the property up in its different components and then depreciating them. Yeah.
Yep. That hasn't changed. What has changed, or what's been tweaked a little, is something called bonus depreciation. So bonus depreciation essentially puts cost segregation on steroids. And what bonus depreciation says, bonus depreciation has been around for a number of years. The government uses it to basically stimulate the economy. So when they want to increase spending in the economy, they go out and say, hey, we're going to give you guys extra incentives to go out and buy stuff. And so bonus depreciation says that any asset that has a useful life of 20 years or less, we're going to allow you to accelerate the depreciation on that. Well, that's great, but real estate has a depreciable life of 27 and a half years. So a lot of tax preparers think that real estate is not eligible for bonus. However, when you do a cost seg study and you identify the 5, 7, and 15-year assets within that building, all of a sudden your 5, 7, and 15-year assets are eligible for bonus. So that's the first thing, is you got to be eligible for bonus. The second thing is with the passing of the new bill, the One Big Beautiful Bill back in July of last year, they reinstated 100% bonus. So my 5-year refrigerator that I would normally take that $1,000 refrigerator and split it up over 5 years, which is still good. It's better than 27 and a half years.
Yeah, it's 20% a year for 5 years. Yeah.
Basically, yeah. But that refrigerator now, instead of taking 20% for 5 years, I get to take 100% of that all in the first year. Not only my refrigerator and all my internal components, but also all my land improvements, my curbs, gutters, asphalt, concrete, retaining walls, trees, bushes, shrubs. All that stuff I get to depreciate over their correct useful lives, but then I get to apply this bonus depreciation to those assets. So that's why bonus depreciation has been a lot in the news lately. There's a lot of podcast articles, social media around bonus depreciation, because it creates huge deductions for real estate investors. So if you own real estate right now and you're paying taxes, there's a good chance that you could utilize some of these bonus depreciation, cost segregation strategies to offset a big portion of that tax bill.
At least for this year. At least
for this year. Yeah.
Yeah.
That's correct.
Okay. So you kind of explained it very well. Thank you. I got my head around that. Single family home, $270,000. Who's actually using cost segregation? Where does this make sense? Where does it not make sense?
Perfect. That's a great question. And this is a kind of a question that I think there's a lot of misinformation on, just because there has been so many changes to some of the rules around cost segregation. So when I started doing this 10 years ago, cost segregation was really for your large institutionalized investors.
Right.
People buying hotels, hospitals, casinos. You pay
huge multifamily properties.
You pay $10 million for a building. You pay $15,000 for a cost seg study. You save $100,000 or $200,000 in taxes, and you go along your way. When bonus depreciation came into play, it made cost segregation a lot more feasible for smaller investors. That's the first thing that changed, is bonus came around. The second thing is, over time, there are a lot more cost segregation providers in the space. And so the fees have come down and the benefits have gone up because of bonus. And so we do cost segregation now on anything from a single family rental home with a starting basis of about $200,000 or more. And when I say basis, what I mean by that is you only get to depreciate your purchase price, but you have to minus out land value. So if you buy a place for $300,000 and your land is worth $50,000 and your building's worth $250,000, well, your starting basis is now $250,000 for depreciation.
Right.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
So, because the land's not going to lose value as well.
Yeah, land. That's how the IRS looks at it. Land just keeps its value. So you always have to minus land value, but anything with a depreciable basis over $200,000 is probably worth looking at, because if you do some quick math, let's say you have again, a $250,000 home. Let's just say the land is determined to be 50. So you've got 200,000 of depreciable basis.
Yeah.
We usually segregate around 30% of that building's value into those shorter asset life buckets per se. So 30% of 200,000 is what? 60,000.
Yeah.
If you're able to take 100% of those $60,000 of deductions in the first year, well, you just created a $60,000 write-off. If you're in a 30% tax bracket, a $60,000 write-off is worth about $18,000 in tax savings. The fee for something like that is probably around $2,000 to $2,500, depending on size and scope of the building. Right. So to pay $25 to save $18, it could be worth it in that case. Now, if you've got a $60,000 home that you purchased, it may not pencil out. Once you minus land value, plus, you might save $3,000, but if we're going to charge you $25 for the study, you're only netting $500, and it may not be worth it. But I always tell investors anything over that $200,000 mark is worth having some initial numbers put together. Just because the numbers in the building are eligible and make sense for cost segregation doesn't mean it's right for you. And let me just get into that real quick.
Yeah.
In that example, we said we could create a $60,000 deduction. I'm going to use myself as an example. I'm a W-2 employee here at Maven, and I own real estate on the side. If I do a cost seg study on my real estate, that $60,000 deduction can only be used to offset my rental income, not my Maven cost segregation W-2 income.
Right.
So typically, inherently, real estate is normally treated as passive income. Therefore, when you do a cost segregation study, those deductions are considered passive deductions. Passive deductions can only be used to offset passive income, not active income. Mm. So if you're listening to this and you're a doctor and you have a rental property that's a long-term rental, and then you paid $1 million for it, we do a cost seg study, we create a $200,000 or $300,000 deduction. That doesn't mean you can use that $300,000 deduction to offset your doctor income by $300,000. You can use that $300,000 to offset any rental income you have or any other type of passive income, but not your doctor income. So for people who have a lot of rental income, cost segregation typically makes sense. For investors who have a full-time job and they invest on the side, that's one where we want to really dive into the situation and say, okay, well, can you utilize these deductions? I don't want you to pay me $2,000, $3,000 for a study if you can't utilize it. Let's say your rental properties only make $5,000 a year in income. Well, it's going to take you 12 years to utilize a $60,000 deduction. You never lose it. It just moves forward and you get to use a little bit.
Okay, I was going to ask that question. All right,
yeah.
So it's not a one-shot deal.
It's not a one-shot deal. If we create a $60,000 deduction and you only have $5,000 of income, we'll offset that $5,000 of income. You pay no tax on it. The $55,000 that's left over, that carries forward into next year. You can use it to offset up to $55,000 of income next year. But what we don't want to see is, in that scenario, you just paid me to accelerate this depreciation, and now it's taking you 12 years on the back end to utilize it. Well, you're kind of offsetting your benefits, right?
Yeah, no, you didn't really need to do that.
You didn't need to do that. You didn't need to accelerate it to then decelerate it.
Yeah.
Cost segregation is really a time value of money play, right? Give me my deductions now versus in the future. But if you can't utilize them now, and you can only
might as well take them distribute the way it's set up for.
Yeah, exactly. So now there's a couple of ways around that. One is becoming a real estate professional for tax purposes. In order to do that, either you or your spouse has to spend 750 hours a year doing real estate activity and at least 51% of your working time doing real estate. So if you're working a full-time 40-hour week job, it's very difficult to qualify as a real estate professional. Even if you spend the 750 hours a year doing real estate, you're not spending more than
51%.
Yeah. So you'd have to work 81 hours a week.
So how does that look practically usually, Eric? What usually happens with a husband and wife when they decide to do it?
That's a good question. So usually what we see is you have a high W-2 earner in the family.
Yeah.
They're off doing their doctor gig or their lawyer gig or whatever it is they do. They have high W-2 income. Because they have high W-2 income, the spouse is able to stay home, and now the spouse manages their rental portfolio. The spouse spends 750 hours a year doing real estate. The spouse spends 51% of their total working time doing real estate. And now what happens is when you go onto your tax form and it asks for your profession, your spouse is saying, I do real estate for a living. Therefore, any deductions within my real estate portfolio are considered active deductions, and now they can't be used to offset my spouse's active doctor income or lawyer income or whatever.
Okay. Yeah, because you're filing jointly. Yeah.
If you file jointly, correct. So that's the first way to get around kind of those passive loss limitations. The second way, I'll just give you two more real quick. One is the short-term rental loophole. Short-term rentals, I hate to call it a loophole because that sounds like you're doing something nefarious, but it's not. It's just the way the tax code is written. But when you own a short-term rental, the IRS doesn't look at that as a piece of rental property. They look at it as you own and operate a hotel. So if your average stay in your rental property is less than 7 days, which typically on an Airbnb type property it is, and you can prove what they call material participation in the management of that property, there's 7 tests that are available. You only have to meet one of those 7 tests. The one that's most commonly met is you have to spend 100 hours at the property and more time than anyone else, more time than your cleaner, your maintenance folks, your property manager. If you can show material participation, the average stay is less than 7 days. The IRS looks at that and says, hey, well, even though you're a doctor full-time, you still own and operate this hotel business.
Yeah.
Therefore, because you own and operate it, you're actively managing it. Those are active deductions, and they can be used to offset your active income.
Oh, okay. Yeah.
So you'll see a lot of W-2 earners buying short-term.
Yeah, I've seen that. Now it's all falling into place.
Yeah.
Very, very cool, Eric. Well, hey, good job explaining that.
Yeah.
I get it. So yeah, no, that's fantastic. So who are you looking to connect with these days, Eric?
Yeah, so we work primarily with any real estate investor, whether you own a basement apartment in your primary home or you own a large multifamily building. Anybody who owns revenue generating property is eligible for cost segregation. Doesn't always mean it's the right fit. And so what we like to do is get on the phone, get some information about you and your property, see if we can potentially save you money. So I would say anybody who owns real estate and who is paying taxes would be somebody we would want to connect with, obviously, because there is a good chance that we could maybe help reduce some of that tax liability through some of these different options.
Very good. So if people want to connect and reach out, where should they go?
Yeah, so you can just go to mavencostseg.com. That's MAVEN COSTSEG, mavencostseg.com / and then my name, Erik, ERIK. And that'll give you a direct link to me. You'll fill out a form and just say, hey, I've got a property. I think I might be interested. I'll get notified. I'll reach out to you. We'll have a conversation, see if it's a good candidate or not. Like I said, it's kind of a twofold process. Is the building a good candidate? And then you yourself and your financial situation a good candidate? If you meet the criteria, we'll put together some initial numbers free of charge. We don't charge for that. We'll run some preliminary numbers. You'll share that typically with your tax preparer to say, hey, I think there's an opportunity for me to possibly save some money. We can jump on the phone with your tax preparer, and then we decide if it makes sense from there.
Very good. Hey, Eric, thanks so much for explaining this cost segregation thing. I think we all get it a lot better now. I really appreciate having you on the show.
Yeah, thank you for having me.
All right, everybody. Thanks for tuning in, and we'll see you again on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.